Okay, so in this lesson, we're going to be looking at candlestick formations. Candlesticks are some of the most powerful technical tools that we're going to be literally using on a regular basis every single day. Every single time we look at a chart, we will be looking at candlestick formations. Pretty much every single one of these red and white bars, that is a candlestick. Now, there's a few different candlesticks that we're mainly going to be focusing on. There's a bunch of them, hundreds of them out there that have been classified into different names and so on. We're mainly going to be focusing on a handful of those, roughly 10 or so. Those are the most powerful candlesticks that literally you will be looking for them every single day. So it's a very important lesson. This is one of your first most important lessons that starts to literally combine a few concepts that we already looked at into this lesson. So with that said, a little bit of context on candlesticks. You can research just a little bit more if you wish, but a candlestick has been developed a long time ago, back in the 18th century in Japan, when people were still trading rice. It was developed by rice traders in the 18th century in Japan. And since then, it was brought over to the Western world by Steve Nissen in roughly 1991, if I'm not mistaken. So Steve Nissen, 1991, brought it into the Western world. And today in this lesson, we're going to be focusing on a handful of those that are some of the most powerful ones. So let's have a look. So the first thing that I want to show you is what actually a candlestick is. A candlestick packs a lot of data into one specific price bar. Okay, so if we look at the chart here, and I'm going to zoom in on this daily chart, so that this was my monthly, weekly, daily layout, and we just have one currency pair here. So we're zooming in, and if we zoom in on just any one of them, these are all candlesticks, by the way. So if we just look at this beautiful candle right here, and what I'm going to do is just jump back in time so we can focus on the actual data. Okay, so first, I'm going to explain what actually a candlestick is and what it actually does. We have a few different concepts here. So we have multiple candlesticks. These are bullish candlesticks. So the ones that you see in white, those are bullish candlesticks. And the ones that you see in red, those are bearish candlesticks, meaning that price is going up and price is going down. Okay. Now, some charts, some people use green for bullish. I choose to use white just for simplicity and minimalism, but you're going to see a lot of the bullish candles are green. I prefer white. But again, when we zoom in here, there's a few different data points that a candlestick actually collects. Okay, it collects the high of the day, it collects the low of the day, it collects the open price and the close price of the day. Okay, so the way this looks, when you look at this little guy right there, okay, and you see that little line, that's called the wick, and this big bar, that's called the body. So we have a wick and we have a body, and typically we have a wick right at the top and right at the bottom, and we have a body right in the middle. Okay, now to go a little bit deeper into this, whenever it's a red bar, okay, like this one, whenever we have a bearish candlestick, so it typically happens price is going up and up and up, okay, and then this candlestick closes, a bullish candlestick closes right here. So this is where the body closes. This is where the daily candlestick has closed, and this is where the new daily candlestick has opened. Okay, so the open and close prices are typically right beside each other. Now, this is a red bar. So this is where the candlestick has closed, and just by looking at this candlestick, we can right away know that price has went up during the day, peaked at the high. Okay, so the wick shows us the high and the extreme low. Okay, so in this case, price opened over here, went to the upside, gave us the high, that was the top of the wick, and then continued lower to give us an extreme low right here. So this was the extreme low. So the wick again shows us the extreme high of the day, and the bottom of the wick shows us the extreme low of the day. So we get the extreme highs, the extreme lows, and so for the open price. And the last piece of the candlestick is the close, which is the bottom part of this body. Okay, so whenever we have a red candle, we have price opens up, the top is the wick, the bottom is the wick, so the extreme high, the extreme low, open price, close price. Okay, now for a bullish candlestick, it's going to look roughly the same. I'm going to show you another example here, and let's just go to this one right there. So this is a bullish candlestick, and you can see it's sitting at a little bit of support, so we can toss that support line in there. That's something that we learned in the previous lessons. And right now, price gave us this bullish candlestick and then another bullish candlestick. So we got two bullish candlesticks. So what do we have here? First of all, we have the close price of the previous one, gives us the open price of the new one. Okay, then price went down, which was the extreme low of this wick. That is the extreme low of the day. Then it continued higher and higher and higher to give us the extreme high of the day, and that's the top of the wick. And then finally the day closed right here, which is the end of the body. So this is a bullish body, so the body opened up over here and it closed right there. So those are some of the main data points that a candlestick gives us. It gives us the extreme high of the day, that is by the top of the wick. It gives us the extreme low of the day, that is the bottom part of the wick, and it gives us the body. The body tells us where the day opened up and where the day has closed. Now I've shown you here the daily candlestick. Now it's also on the monthly chart. You can see it on the weekly chart, on the 4-hour chart, on the 1-hour chart, on the 5-minute chart. Every single time frame has candlesticks, and on every single time frame we're going to be focusing on them based on where they open, where they close, where's the extreme high, and where's the extreme low. Now, that is what a candlestick actually looks like and what it does. But there's a few different candlestick patterns that we're actually going to be focusing on that tells us that there's a reversal in price or a potential reversal in price coming. So whenever we see these specific candlesticks that I'm going to show you, they typically mean that price is going down, and when we get this reversal candlestick, price is going to go up to the upside. So reversal candlesticks, that's what we're going to be focusing on mainly in this lesson, are reversal candlestick patterns. So if we come back, one of the first candlesticks I'm going to show you is one that is called a low test and a high test reversal. So first we're going to be focusing on a low test reversal candlestick. So on the chart here, we have again the daily time frame, the monthly time frame, the weekly time frame. One thing to remember is that on a monthly chart, this is 1 month. Okay, on a weekly chart, one candle is 1 week. On a daily chart, one candle is 1 day, and so on the intraday charts. But also something to remember is that on a monthly chart, this one candle is 4 weeks worth of candlesticks on the weekly time frame. Okay, so this one candle on a monthly chart is a combination of four different candlesticks on a weekly time frame. Same thing on a daily chart. One candle on a weekly is a combination of 5 candlesticks on a daily chart. If you're trading cryptocurrency, it's a combination of 7 daily candlesticks. Okay, so one weekly is for Forex and stocks. One weekly candle is 5 daily candles, and for cryptocurrency, one weekly candle is 7 daily candles. Now the same thing goes for the intraday charts. So one daily candle is 24 hours, right? So one day is 24 hours. So on a daily chart, on a lower time frame, such as the 1-hour time frame, a one daily candle will be a combination of 24 1-hour candles. Okay, so that's just something to remember whenever you're looking at candlesticks on different time frames. But this next candlestick that I'm going to show you is one of the most important candlestick price action patterns, and that is the high test and the low test reversal candlestick. So what we have here is a high test reversal, and whenever we get this high test reversal, I'll explain it in a second. Let's make it larger. It means that price typically happens after a pullback, right? So we're in this bearish trend, we're moving down and down and down, and then price has this pullback. And when a high test happens, it happens at the end of the bullish run. Okay, so that's something to remember. It's a high test will either happen at the end of a bullish run or at the end of a pullback, one of those. End of a run, end of a pullback. And a high test looks like this. It's when the wick of a candle is larger than the body of the candle, okay? So in this case, it's a high test. So the upper wick of the candle needs to be larger than the body of the candle, okay? That tells us that price went up during the day and continued to go up and up and up throughout the day. But about halfway throughout the day, it actually turned around and the bearish pressure came in to give us a bearish high test reversal. So pretty much the high test means that the wick during the day has, or in this case, an hour. So because this is a 1 hour chart. So this wick within this hour tested this resistance, which is the 1 hour 50 EMA, okay? The wick has tested the 1 hour 50 EMA and has rejected it because the bears took over and this actual candlestick closed bearish. So this is what a high test reversal looks like. I'm going to show you another example of a high test reversal. And let me just zoom out here on the charts. I have many low test reversals, so let's just jump right into a low test reversal, and I'll show you a few other examples. So this is a low test. Low test is the exact same thing. It's just it happens at the bottom of price action, at the bottom of a run or at the bottom of a pullback, whereas a high test happens at the top of a run or top of a pullback. A low test actually happens at the bottom of a run or at the bottom of a pullback. So when we go back on the chart here, what we have here is price has been running down and down and down until it gave us this low test reversal candlestick. Okay, so in this case, it's a bullish low test reversal because it is white or green, depending on which color you choose for yourself. But this is a bullish reversal candlestick. So it means that during this 1 hour, price has tested these extreme lows, and then the bulls have taken over and pushed price back up to give us this massive long wick. So whenever we have these big long wicks, that's typically when a low test or a high test happens, right? And they need to happen at the bottom of the runs or at the top of the runs, not kind of in the middle. It has to be at the extreme highs or the extreme lows, sitting at major support and resistance levels. So we already looked at support and resistance previously, right? A good candlestick reversal, doesn't matter whether it's a high test or any of the other ones I'm going to show you here, a good reversal candlestick will happen at those major support and resistance levels, whether it's horizontal, trend line, 50 EMA, or all of them. It's the best case scenario is when you have all of them lining up and then you get a reversal candlestick, because the reversal candlestick actually tells us that that level is being rejected. So in this case, this low test means that price during this 1 hour has actually went down, tested this extreme low, and then went all the way up. Bullish pressure came in to close this candlestick as a bullish low test reversal. So that is a high test and a low test reversal candlestick pattern. You're going to see many of them throughout this masterclass. This is what they look like. And as we go through this lesson, literally every single lesson, we will be looking at those candlestick formations. So you're going to have a lot of exposure to them. And when you look at the charts yourself, again, that's what you're looking for. You're looking for these reversal candlesticks. So in this case, a low test and a high test are some of my favorite reversal candlestick formation patterns. The next one that we're going to be looking at are tweezer tops and tweezer bottoms, which pretty much combines, a tweezer top combines 2 high test reversals, and a tweezer bottom combines 2 low test reversals. So let's come back to the chart to actually show you that. So a tweezer bottom and a tweezer top, like I mentioned earlier, looks exactly like a high test and a low test, but there's just 2 of them. So when we look at the charts here, right away, what I want to show you is this monthly chart on New Zealand dollar. And right here where I drew the arrow, let me just jump back in time to this point, and you'll see that this is what a tweezer top reversal candlestick formation looks like. I'm going to make this larger. So what we have here is, you can see that we have two high test reversals. One is a bullish high test. The reason why I say it's a bullish high test is just because it's a bullish candlestick. Price opened down here and closed up here, but it's still a high test, right? It still gives us this massive bullish wick. You know, it's a high test, but it's a bullish high test versus this is a bearish high test because it's a bearish candle. Still, we have this massive bullish wick, but the candle closed bearish. So perfect tweezer top candlestick formation gives us something like that. It gives us a bullish high test and followed by a bearish high test right after. It's not always the case. Sometimes we have two bearish high tests, or sometimes we have two bullish high tests and so on. But the most perfect tweezer top candlestick formation that we can have is one is bullish and one is bearish, exactly like we have here on the chart. So one high test, price opened down here, tested all the highs, and then ended up closing above the price where it opened, hence why it's a bullish candlestick formation. Bullish high test reversal, I mean. And the second one opened where the previous one closed, right? Tested the highs and then fell right back down and had a bearish close, hence why it's a bearish high test reversal. And whenever we see something like this, both of these candlesticks combined together like that, so two high tests, that gives us a tweezer top reversal pattern. And this is one of the strongest candlestick formation patterns that we can have visible on a chart. And whenever I see a tweezer top or a tweezer bottom, that is a very strong signal. And I would argue that it's one of the strongest candlestick formation patterns that we can actually witness on a chart. So they're very important. And this is just one example of what a tweezer top looks like. And interestingly enough, this is 2008, March 2008, right before the global recession. Just for the fun of it, check this out. What we're gonna do is jump forward. And this is the global recession. So you can see that this tweezer top actually predicted a bearish reversal in price, and it actually predicted the global recession, or was right in time for the global recession. Many things predicted the global recession back in the day, but this tweezer top candlestick formation was a technical indicator telling us that price is about to reverse and something's about to happen. And in that case, it was actually the global recession of 2008-2009. Now, another example of a tweezer top reversal pattern is right here on a daily chart. And again, same kind of thing. So when we zoom in on this one, I'm going to jump back in time. Again, we have the exact same thing. We have a little bit of resistance here, which is the previous high. You can see here that this is a perfect high test reversal that we already talked about previously. So this is an example of a beautiful high test. And in this case over here, we have two high test reversals. One of them again is bearish, so it gives us this massive bullish wick to the upside. And then the second one is a bearish high test reversal, which gives us again this bullish wick to the upside, but closes bearish. So this is a beautiful example of another tweezer top reversal candlestick formation pattern. Now, just for the fun of it, we also have bearish MACD divergence. So something we already talked about in the previous lessons. Double tops, bearish MACD. Beautiful. So tweezer top reversal patterns, that's what they look like. Let me show you a few more examples of this. And right here, again, I'm going to show you a monthly time frame. And this is a combination of a few reversal candlesticks. So we have a bearish high test reversal. Again, it's a bearish high test reversal because again, it closes a bearish candle. In this case, it's a red candle, right? So massive high test and then close bearish. So that is a high test. And here we have two high test candles combined together. So that is a tweezer top reversal candlestick formation pattern. We have one high test reversal, which closed bullish, and the second one opened up, tested the highs again, right? And then closed bearish. So just for you to know, this is a monthly chart. And you see how these monthly high test candles are testing this level? Well, this is a significant level on the daily time frame. These are the extreme highs on the daily chart and the extreme highs on the lower time frames as well. So that is what these high tests are testing. And again, this is what a beautiful tweezer top reversal candlestick pattern looks like. Now I have another example here on the chart of a beautiful tweezer top. Looks a little bit different. It's a different example because actually two candlesticks are bearish. So when we look at this weekly time frame here, again, even right here where I have the arrow marked in, this is what I would call a bearish tweezer top reversal pattern. And both candlesticks are kind of high test, specifically this one. The first one is definitely a high test reversal. The second one is turning more into bearish engulfing, but it's still a high test reversal. We're going to be looking at bearish engulfing candlesticks in a bit, but combined together, both of them tested the highs here and closed with massive wicks, therefore giving us two high test reversals, and therefore it's a tweezer top reversal candlestick formation pattern. And those are the tweezer tops. They are bearish reversal candlestick patterns. They happen at the top of the runs or at the top of pullbacks. And whenever we see those two high test candles combined together, that is a very strong signal to actually go short. Now what I'm actually going to show you are the bullish representation of that, which is a tweezer bottom. Okay, and it's two low test reversal candlesticks combined together. So when we look at the chart here, and I'm going to go to actually a lower time frame, I'll show you what it looks like on the 1 hour chart. And here I'm going to make this larger. In this case, we have two tweezer bottom reversal candlestick formation patterns right at the lows here. So the first one happened right here. Price went down and down and down, gave us this one bearish low test reversal. Again, it's bearish because it closes a bearish candle. It's red, but it's still a low test because of this massive bearish wick. Okay, and the price pulled back to the upside. Then the second candlestick opened up, tested the lows, tested the extreme lows, and then price went up and actually closed as a bullish low test reversal. So this is a tweezer bottom. In this case, it's the same right here. We have one candle which tested the lows, closed bearish. Second one opened up, tested the lows, and closed bullish. And that again is a bullish tweezer bottom reversal candlestick formation pattern. So that is it for the tweezer bottom and tweezer tops reversal candlestick formation patterns. They're some of the most powerful candlestick formation patterns that we actually have. And whenever I see them on the charts, again, they're really powerful. So I make sure to actually focus on them a little bit more, make sure that they're sitting at major support and resistance levels and so on and so on. And you're going to see many more examples of what these candlestick formation patterns actually look like in the next lessons. But for now, let's have a look at the next one. And the next candlestick formation is a bearish engulfing and a bullish engulfing. They're very powerful, almost as powerful, I would say, as a tweezer bottom and a tweezer top, maybe even a little bit more depending on who you talk to. But a bullish engulfing and a bearish engulfing is an extremely powerful candlestick formation pattern. So let's have a look at them. So bearish engulfing and a bullish engulfing is a candlestick formation pattern that is much larger than the previous candle. And this is important to know. Whenever you see a bearish engulfing and a bullish engulfing, I'm going to show you that exactly right now. But that candlestick, that bearish engulfing or that bullish engulfing candlestick is much larger than the candlestick right next to it. So when we look at the charts, right here on this 1 hour time frame, we have an example of a massive bearish engulfing reversal candlestick. And that is right here. So that is what I would call a massive, a very huge bearish engulfing reversal, because it's obviously much larger than the previous candle, right? So the previous candles are quite small. And again, they're sitting at resistance here. So these are reversal candlestick formation patterns. So we want to make sure that there's some resistance in the region, whether it's horizontal, the 50 EMA or whatnot. So in this case, we have some strong extreme highs. Then price action decelerated and gave us this big bearish engulfing reversal candlestick formation pattern. Now, if we continue a little bit more, here's another one. So this is another example of a bearish engulfing reversal candlestick formation pattern. But again, this one's not sitting at any major resistance. So this one's a major resistance. It's much stronger. It's much better. This one's also bearish engulfing reversal candlestick, but it's not a major resistance. Major resistance was up there. Now, another example of a very strong bearish engulfing is here on the 4-hour chart. So if we look at the 4-hour time frame right away, we have a few. Number one is over here. So this is a great bearish engulfing. This is what it will typically look like. The previous example was a massive bearish engulfing reversal candlestick. This is more appropriate. This is typically what a bearish engulfing or a bullish engulfing will look like. So price is going up and up and up. They happen at the top of a run. So if it's a bearish engulfing, again, it happens at the top of a run. A bearish engulfing means that it's a bearish reversal candlestick, and therefore it tells us that price is about to reverse and head lower. So in this case, this bearish engulfing, as looking on the chart here, is a much larger candlestick than the previous candle. Okay, so this is a 4-hour chart. The previous 4-hour candle is bullish, and the current 4-hour candlestick is a very big bearish engulfing reversal candlestick. So that is what a bearish engulfing looks like. Now I'm going to show you what a bullish engulfing looks like, which is the same thing, except the bullish engulfing happens at the bottom, right? A bearish engulfing happens at the top. You saw all of these candlesticks, they happen at the top, and they predicted a bearish reversal in price. A bullish engulfing is the exact same thing. It just happens at the bottom, and then we get this big bullish candle that's much larger than the previous candle next to it, and that is a bullish reversal candlestick. So on the charts here, right away, my eye goes to this candle right here, which is a big bullish engulfing reversal. So we have this big bearish run, price is going lower and lower and lower, and then all of a sudden we have this big bullish candle, and that is again a bullish engulfing. It's engulfing because it engulfs the previous candle next to it, and it's much larger than it. And the last example of a bullish engulfing is right here. And this is a little bit of a smaller bullish engulfing reversal. Let me just jump right to it. Here it is. And when I make this larger, right away you can see immediately that this candle is much larger than the candle next to it. So that is a bullish engulfing reversal. And an important lesson here is that we still need support and resistance, right? So whenever we get these reversal candlestick formation patterns, they need to happen at some kind of support and resistance. So always make sure that when you see a bullish reversal or a bearish reversal, whether it's a high test, low test, tweezer top, tweezer bottom, bullish engulfing, bearish engulfing, and a few others that I'm going to show you in a bit as well, make sure that they are again rejecting something. They are reversal candlestick formations, so they have to be rejecting something to tell us that price is actually turning around. So they should be at good levels, whether it's horizontal, trend line, 50 EMA, and so on. So in this case, you can really quickly just zoom out on the chart whenever you see that and make sure that it's actually sitting at some kind of support, that this level is actually being respected and rejected. And when we zoom out on this time frame, you can see that this level is slightly being rejected. We have 1, 2, 3, 4, 5 rejections roughly off of this area. And then we have this bullish engulfing that happened right after it. And then if we fast forward a little bit, there we go. Price rejected that level and continued a little bit up. Not too much, it's a pullback play, but it continued a little bit higher. So that is it for bearish engulfing and bullish engulfing reversals. They're very good whenever you see them on a chart. It means that price action is actually rejecting a specific level, and then we have this big push to the upside that gives us a bullish engulfing, or a big push to the downside that gives us a bearish engulfing reversal. The next pattern that we're going to look at, the next candlestick formation, is not so common, but it happens once in a while, and that is a hammer and an inverted hammer. It pretty much looks like a lotus and a high test. It's just, it happens not where it's supposed to happen. So a high test typically happens at the top of a run, right? And a low test typically happens at the bottom of a run. invert a hammer and a hammer. So a hammer will be a low test that actually happens at the top of a run. That's also a reversal candlestick formation. That is called a hammer. Okay, so I'll show you exactly what that looks like on the chart. And an inverted hammer is a high test that actually happens at the bottom of a run, right? That gives us a reversal candlestick. So let's have a look. So as I just mentioned, an inverted hammer and a hammer are pretty much a low test and a high test, but in the opposite direction. So when we look at the chart here, right away, I'm going to show it to you here on a monthly time frame, is an inverted hammer, or actually this is a hammer, followed by a high test reversal. So the one thing to note with these next few candlestick formations that I'm going to show you, which is the hammer and the inverted hammer and then following a doji and an inside bar, they are not as strong as the candlestick formations that I just showed you earlier today, such as the high test, the low test, the tweezer top, the tweezer bottom, bearish engulfing, and bullish engulfing. Okay, these next few, they are strong when there's a combination of candlestick formation patterns. Okay, so in this case, when we look at this monthly time frame, right away we have the monthly 50 EMA, so we have resistance. That is good. This candle right here, you can see that this is a low test, right? Price is going up, but it's a low test. We get this test to the downside, and then it closes as a low test reversal. But because it happens at the top of a run instead of at the bottom of a run, like this lotus over here or this little lotus over there, right? These are happening at the bottom of a run. This is a lotus that happens at the top of a run, and that means that this is a hammer reversal. It even looks like a hammer, right? We get the head of a hammer and we get the handle of the hammer, right? That's where the name actually comes from. It actually looks like a hammer. So this is a hammer reversal candlestick. Now, to me personally, they are really strong when they are combined with other reversal candlestick formations. So in this case, it's combined with a high test reversal, and that to me is now a really strong rejection of this monthly 50 EMA. So that is a really good example of what a hammer reversal looks like. Let me show you another one. So if we go down to the lower time frames here, I have another hammer reversal on the 4-hour chart, right? So we got resistance. So if we zoom out real quick, you'll notice that what was not once support in this general region, we have a bunch of bounces off of this level, becomes resistance, right? And then price rally to the upside, so we have a bullish run, but then we have this low test reversal setup. So to me, this is again a hammer type of reversal. It's not the cleanest, but again, we have this big test to the downside, and then price goes back up to pretty much the entry level or the open level, right? Previous day closed over here, or this is a 4-hour candle, so the previous 4-hour candle closed over here, then the new one opened, price tested the bottoms, and then rallied back up to close right beside the open price. So it gives us this lotus reversal. But again, it happens at the end of the run, at the top of a bullish run, and because of that, that is a hammer reversal. And then over here we have this long-legged doji, and then it just continues to go down. So that is what a hammer looks like. And to tell you the truth, that is not a very common reversal candlestick formation pattern. Happens once in a while, and when it happens, typically I will dig a little bit deeper into it and potentially wait a candle, or wait an hour, or wait 4 hours, or wait a day for another candle to kind of give me a little bit more confirmation, such as a high test or a bearish engulfing following it. So this is what a hammer looks like. Now let me show you what an inverted hammer looks like. And if we go here to the monthly chart on pound dollar, right away you're going to notice a beautiful combination of a few reversal candlesticks. And right here we have a big bearish run to the downside, followed by this massive low test, then an inverted hammer, right, which is again this high test but at the bottom of a run, and then followed by another type of low test, and price is starting to go up to the upside. This is what I call deceleration. Over here, price is slowing down and decelerating, and we're actually going to be looking at deceleration in the next lesson, but this is what I would call deceleration. So whenever we get these hammers or inverted hammers, a lot of times they are part of this deceleration that happens on a chart, which means that price action is slowing down and we're starting to develop these reversal candlestick formation patterns that will cause eventually for price to turn around. So this is an example again of an inverted hammer right in the middle there. And the last example that I'm going to give you of an inverted hammer is right here on the weekly time frame. And this is again a really good example of it. We have major support, you can see that here, previous low, current low. And then if I jump back to this example, there we go. So what we have here is again an inverted hammer right at the bottom of a run. This is, I would say, the best example of an inverted hammer. And again, price is heading lower and lower and lower, so we have a bearish run, and then we get this massive high test, right? Price goes up and then falls right back down. And this is again a high test at the bottom of a run, which gives us an inverted hammer. Okay, right after that we get this low test reversal and the price exploded to the upside. So price decelerated, gave us this inverted hammer, low test, explosion in the opposite direction off of this beautiful support level. So that is it when it comes to hammers and inverted hammers. Know that they are again high test and low test, but in the opposite direction, right? So when it's a bullish run and we have a low test, that is a hammer. And when it's a bearish run and we have a high test, that is an inverted hammer. They are rare, but they happen once in a while. And for myself, whenever I see them on a chart, I typically wait for a little bit more, such as the next candle to be another reversal, such as a low test or a high test or a tweezer bottom or a bullish engulfing, one of those. You know, whenever I see a hammer or an inverted hammer, to me, often that is not enough, and I will wait a little bit longer for the next candle to develop. The next ones I'll show you are roughly the same concept, doji and an inside bar. So right now I'll show you a few dojis, and to me, a doji is same thing. Whenever I see a doji on a chart, typically I want to wait and see a little bit more. So I'll wait for the next candlestick or the next candlestick right after that, because a doji tells me that price action is stalling, it's slowing down. But a doji doesn't necessarily tell me that something was just rejected, right? That we're going to reverse in the opposite direction. A doji is a reversal candlestick formation pattern, but it's a weak one. To me, it just tells me that price action is slowing down or has stopped altogether. So let me show you. And when we look at the chart here on the daily time frame, right away I'm going to zoom in here, and what we have here is a combination of two dojis. Okay, a doji, a lot of the times you might get one doji, or you might get two dojis or three dojis or four dojis all lined up together. So if I zoom in on this a little bit closer, so again, we want to make sure that there's some kind of support or resistance. In this case, we have the previous lows. And a doji is this very small candlestick formation, right? It's very small, where the wicks are pretty much tiny and the body, specifically the body of the candle, is small. So a doji, an ideal doji is a very small candlestick where the wicks could even be much smaller than the wicks here. Imagine them cut in half. Okay, and then we have a very small body as well. So this is a double doji. Okay, a double doji again means that price action is decelerating and it should reverse to the upside. So if I show you another example, there's many dojis running around. Over here we even have another example of a hammer right there, right? So we started this bearish run, had this pullback, hammer, high test, bearish run to the downside. Right, so that's just something that came up. But let me see if I can find you another doji on the chart. If we jump right back to this time here, we are in a bearish run, and then all of a sudden we're decelerating. We have this low test. This is called an inside bar, which I'll show you, talk a little bit about it in a second. And right here we have a double doji once again, and then price turned around and went higher from there. Okay, and here we have a high test reversal. So just an example. So double doji or single doji can happen at the top of a run or at the bottom of a run. Is the same candlestick. right? It just means that there's a very small body and a very small upper wick and a lower wick. It just means that it's a very small candlestick formation, right? And whenever I see a doji on the chart, again, it means that price action is slowing down, it's decelerating, but typically I want to wait and see a little bit more before I actually take a trade in the opposite direction. So that is what a doji looks like. Now the last one that I'll show you, same concept, but it's an inside bar. So let's have a look at that. So an inside bar is a very similar candlestick formation to a bullish engulfing or a bearish engulfing. It's just the opposite. So bullish engulfing is this big candle that's much larger than the previous candle before it, right? Same thing with a bearish engulfing. It's a big bearish candle which is much larger than the previous candle before it. An inside bar is much smaller than the previous candle before it, or just smaller than the previous candle before it. Doesn't necessarily have to be much smaller, but it is just smaller than the previous candle before it. So looking at the chart here, on the weekly chart right away, what we have here is an inside bar. And this is an inside bar that is, again, smaller. This candlestick is smaller than the previous candle before it, and the price continuing going up from there. So it's not the strongest reversal candlestick formation pattern. Typically, whenever I see an inside bar, I want to make sure that there's a little bit more going on to it. And so I will look at the lower time frames and do a process called multi-time frame analysis, which again, I'll explain that concept in the next lessons coming up. But with every single one of these candlesticks, whether it's a high test or a low test or a doji or an inside bar, I do a process called multi-time frame analysis where I make sure that the lower time frame actually confirms that this level is actually being rejected and price is turning around to the upside. But for now, an inside bar just means that this level is being rejected, but to me, it's not the strongest rejection. In this case, on the chart, it turned out beautifully. It looked beautiful, and we get this inside bar and the price exploded to the upside, right? Now, another example of that is right here, where we have a combination, okay? And we have this low test, followed by an inside bar, followed by a doji, and the price continued to go up to the upside, right? So that again is an inside bar because it's much smaller than the candle before it. Now, let me show you a few more examples. And what I'm going to show you here is a combination of how you really approach the charts altogether with the last few lessons that we already learned. So when we look at this monthly chart, I'm going to wrap up this lesson with this concept. When we look at this chart right here, right away we can see that we have this horizontal support and resistance, which is really strong. Previous lows, previous lows, previous lows, previous lows. And what was once support became resistance. So this is again a level that we want to be focusing on. In addition to that, we also have the monthly 50 EMA in this area. Great. So now we have a monthly 50 and we have this horizontal support and resistance level. Now, a Fibonacci tool is something that again you'll learn in the next lessons, but we also have a rejection of 0.3 to Fibonacci retracement. So we got 3 resistance levels. Fibonacci also gives us resistance, and you'll learn about this tool in the coming up lessons. But we got horizontal support and resistance, we got the 50 EMA, which is dynamic support and resistance, and we got Fibonacci 0.3 to Fibonacci, which is again a horizontal resistance level. And pull back to reject this area, and then what we have here is right there an inside bar, because it's a bearish inside bar. It's much smaller than the candlestick before it. So that is what a bearish inside bar looks like. And then right after that we have a bearish high test reversal. So this is a really good candlestick formation pattern. It's where multiple candlesticks are combined together to give us a really good rejection on the chart. And right here on the chart, this is a perfect example of that. It's where price action is decelerating at a certain level. Again, we're going to touch on deceleration in the next lesson. So this is deceleration, and deceleration happens when we get multiple of these candlestick formations together at a specific horizontal level or some kind of support and resistance level. In this case here we have another inside bar followed by a high test, And lastly, just another inside bar example just to engrave it a little bit into your mind. Here it is. We have a little bit of resistance here at the previous highs. Not much, not the best example of resistance, but again, just so you know what an inside bar looks like, here's another one of those. Big bullish candle and then a smaller inside bar, which again is a reversal candlestick formation pattern, and the price fell down. And here's another one of those examples. Again, we have this big bullish candle and then an inside bar following it. So that is it for this lesson. I hope you enjoyed it. What you've learned here are some of the most common candlestick formation patterns that, again, I look for them every single day. Whenever I'm about to take a trade, I make sure that one of those candlestick formation patterns is there. So what you learned here are some of the major ones, such as the high test and a low test, the bearish engulfing and a bullish engulfing, tweezer top and a tweezer bottom. They are some of the strongest candlestick formation patterns that we have visible in the market on a regular basis. They are the ones I focus on the most. The other ones, such as the inverted hammer and the hammer, the doji and the inside bar, are the secondary candlestick formation patterns that I look at again on a regular basis. The first ones are the majors. Whenever I see them, I'm good to go. The second ones, I prefer to wait and see a little bit more on the chart before I actually execute the trade. So that's the doji, the inside bar, the hammer, or the inverted hammer. I prefer to wait for a little bit more development on the chart before executing trades that have those candlestick formation patterns within them. But that is it. If you know them, you'll be good to actually analyze the chart and make sure that whenever you're looking for these candlestick formation patterns, you're actually making sure that they are at very strong support and resistance levels, whether it's horizontal, trend line, or the 50 EMA, or even better, all of them combined together. You want to make sure that because these are reversal candlestick formations, that they are actually happening at strong support and resistance levels, because again, you want to make sure that price is actually reversing from those areas. And whenever we get a candlestick like that at key support and resistance, that means that chances are we're going to have a reversal in the opposite direction. So that is it for this lesson. I hope you enjoyed it, and I'll see you in the next one.